Hi folks, thank you for joining us on Who Moved the Market. I'm sure you're moving to good spirits because it is the festive week and we have a holiday coming up tomorrow. But before you start all the festivities and all the fun and the fervor of Holi, we've got some very interesting stocks lined up for you. Today we're going to keep it quick and snappy. One of them is popping on the upside. The other two, they're from the consumer space, they are trending down. And we'll get to each one of them in just a bit. But to kick things off, I have with me Sonal Bhutra. And we're going to talk about one of the stocks that she tracks, which is doing extremely well in today's trading action. And that's Mahanagar Gas. Now, Sonal, we know they've done this acquisition, but what is so special about it that's getting the market so excited?
So the first thing is that is the first ever inorganic move that the company has made. For Mahanagar Gas, volumes have always been a problem. And that is one of the reasons why people preferred, say, IGL or Gujarat Gas over Mahanagar Gas. They've not been able to increase their volumes for many, many quarters. I was just going through the data as well from Q4 of FY19 to now, that is the last quarter, Q3 of FY23, their volumes have been in the range of 3 to 3.4 MMSCMD. So there has been no growth, so to say, for this particular company because they were just around Thane, Mumbai and Raigad region. So that was the issue, that how will the company expand? How will they grow? Because these are the areas it is limited to. Now, that is something which they are able to address with this acquisition because the other areas that they will be going to, it has Latur, it has Osmanabad. So these areas will give them access to more geographical areas which will add to volumes for the company. And it's just not limited to Maharashtra. There are some cities in Karnataka as well. So that is the reason why the street is excited for, because there was always a question, how will Mahanagar Gas grow their business from here on? Because there's a limited area in terms of volumes. So while their volumes were lower, they could grow only via price hike. So if we look at their EBITDA per unit as well, it has increased over last 3 years from around 8 rupees to 11.5 rupees in the last year, that is FY22. So that's
only
major,
because of price hikes, not only because of volume growth.
Exactly. So it was led always by margin growth for the company. Volumes were always an issue, and that's why this is an exciting factor that has just kicked in for the company.
Okay, that really explains it now. Tell us more about the company. The name is Unison Enviro Private Limited, right? I believe it's a loss-making company. I totally get your point about all the new geographies it adds for NGL. Is it loss-making? What's the street view? Is that a concern at all?
So, yeah, the concerns are higher valuations at which it has been bought by the company, around 6.4 times trailing price to book. So that definitely is a concern. It's loss-making. But the thing is, their losses have been narrowing and revenues have been growing. So that at least
on the
answers.
Right track, at least.
Yes, it is on the right track, and it is in the growth phase because they have also not operationalized completely. It is also a subsidiary, so to say, of a subsidiary of Ashoka Buildcon. So Ashoka Buildcon held this arm, City Gas arm, and they have sold it to Mahanagar Gas. So it did not come from, it came from a relatively known company as well.
Known entity. Has comfort with Ashoka
Yes,
Buildcon.
Ashoka Buildcon, exactly. So that's one of the reasons why they're like, okay, even if this company has been acquired, they will be able to scale it. And Mahanagar Gas hasn't had the problem of scaling these growth in terms of volumes because they have a good track record with their overall operations. It was just that where to grow it from. So now this has come through. The second thing is, as I said, it is into states like Maharashtra, Karnataka, and these three geographical areas that the company has acquired, they have the network exclusivity till FY41, FY43. So it gives them a long rope.
So they are going to be the sole players in at least these areas.
Yes,
the network. Monopoly.
Exactly. So at least network monopoly they'll get, exclusivity they'll get, and these are populated areas as well. So even though we would say, okay, these are small towns or tier 2, tier 3 cities, there is scope because there's a lot of industrialization happening around. So not only the retail volumes, they will be able to cater to the commercial volumes there as well. So that's one of the reasons why, okay, maybe 6.4 times, it's a big number, so to say, price to book, but growth prospects. Because
you're paying for growth,
yes, you're paying for growth because if you look at the revenues as well, from 7 crores in FY20, they have scaled it up to 90 crores right now. They made EBITDA loss in FY20, which has turned into EBITDA profit in FY22.
Okay,
so definitely,
that's inspiring that things are sort of moving in the right direction.
Correct.
Since volumes is what this conversation is really all about, are there any estimates right now on the street? It's still early days in terms of how much will that volume kicker be? 5%, 10%, let's say over the next couple of years for Mahanagar Gas?
Yes, so as I said, the company is doing volumes of 3.4 MMSCMD. Each of the geographical area will be able to give Mahanagar Gas around 0.2 to 0.25 MMSCMD. Of course, they still have to develop it. And ICICI Securities has put out a note where they say that by FY28, say next 5 years, with all the capex, all the capex that the company will be able to put, 500 to 600 crore rupees, they will be able to add volumes of 1 MMSCMD. So that's not bad. If 25% of the volumes in future is going to come from this particular acquisition that the company's made, it's substantial. Not only volumes, EBITDA per SCM for Mahanagar Gas in the sector is one of the highest. This particular acquisition will add EBITDA per unit of 5 to 5.5 rupees per unit.
Okay.
So the current EBITDA per unit is around 11. It'll add around 5 to 5.5 rupees per unit. So that translates to additional EBITDA of around 200 crore rupees in next 5 years.
Okay.
That is some estimates that the brokerages have put out. So that definitely financially also makes sense for MGL.
Okay, I guess then that really does make for a very compelling case, and that explains why the market's completely given its thumbs up to the acquisition. Before we let you go, just sort of pick a broader question on how a lot of these city gas distribution companies, IGL for instance is also excited today, how have they been performing? And I'm just wondering if it's going to actually increase the competitive intensity now that Mahanagar is getting aggressive and it's really going full throttle.
So interestingly, IGL on our channel told us that, in a post-result conversation that they are also looking at acquisitions, and not in the NCR region, but Karnataka, Maharashtra belt. So that is something which is something that Street is keeping in their mind as well. So we will have to watch out for that as well, whether IGL is as aggressive as Mahanagar Gas in terms of acquisition and in terms of expansion as well. As far as their performance is concerned, Q3 we all know we had higher gas prices, which was a big headwind. We had the domestic gas prices which increased from October, and that is something that put pressure on margins for all these companies. IGL, that's the reason, saw a quarter-on-quarter decline, but a YOY increase because it was a low base. But if we talk about the other companies, so to say, gas prices continue to be a big headwind for all three of them. IGL did not go across and hike prices. They only focused on volume. So that's why their margins were hit. For Gujarat Gas, majority of their revenues come in from the industrial segment. For that, they buy spot LNG or prices at spot prices. And that's the reason why their margins were hurt, because spot prices were way higher than the domestic prices as well. So Gujarat Gas had that problem. But with Mahanagar Gas, they were able to increase prices without hurting their volume. So Q3 was good for them. They were an outlier in Q3. That time also the stock was very impressed, or the street was very impressed. The stock was excited. So Mahanagar Gas that way did well in Q3. And valuation support is something that Mahanagar Gas has. It is the cheapest in the city gas distribution space. So that really works for them if they are able to expand. They have better valuations versus the peers. They have better margins versus the peers. And they have been able to manage volume. So they've been able to manage margins so far. So that is working for the stock.
And now they get the volume kicker as well.
Yes.
Okay, Sonal, that really puts things in perspective. Thank you very much for that comprehensive explanation. That's Mahanagar Gas for you. It's up and about. It's chosen to go with the green color when we're talking about the festival of colors. Now we'll talk about the red. How can there not be any red if we are talking it's holy? It's a mix of colors, right? The red is coming in from two consumer companies today in the market. One is Britannia, poorest performer on the Nifty when the market otherwise in such good mood. The other is Nykaa. Mangalam's joining in to explain what's happening over here. Mangalam, it's okay. There's a lot of green, so we can do with some red as well, which you're bringing in today. Tell us first of all, Britannia, CLSA, suddenly getting cautious and coming up with commentary, raising questions on things like I think raw material inputs, competition. That's for Nykaa. That's coming up later. But what is CLSA's issue here? Starting with Britannia first.
Starting with Britannia, CLSA, you said it's suddenly come up with this report. Yes, it is suddenly come up with this report, but the point is that they have been underperformers on the stock already. Right? They had an underperform rating, which they've now downgraded to sell. They have a target price of 4,060 odd rupees. The biggest problem that they have right now is that they believe that margins that the street is working with for Britannia may be the company report margins which are below the consensus estimates. Why is that? Because wheat and milk inflation could impact their margins going forward. I don't know whether that would happen or not, I'll be very honest. Why is that? Because the company reported margins of 19.5% in the third quarter. Since then, the margins of the company are likely to improve because wheat prices have come down by 32% from the peak. Milk, while it is still at an all-time high, it's not a major raw material from Britannia. It's no more than 5 to 10% of their overall raw material basket. The majority raw material basket for them is palm oil prices, palm fatty acid oil. We have wheat and we have sugar. Wheat, sugar, palm, all of them have come off the highs. We have packaging prices which have also come off the highs. So margins actually are likely to be higher.
Okay.
The street is anticipating margins of 17.5% on a consensus basis in FY24, whereas Britannia has reported 19.5% in the third quarter already. So for one to believe that maybe the company would report margins which are below consensus, I think I don't know yet enough about it.
Okay.
The second thing is that they're concerned about the valuation of the stock. The stock is up around 30% in the last 1 year, trading at a valuation of about, what, 43, 44 times 1 year forward earnings. In the past, it has traded close to 50, 53 times as well.
I don't think we've ever spoken about cheap valuations in consumer
Britannia.
companies in the same sentence.
Exactly. So while there is limited room for upmove because of the 30% upmove that we've seen already, which CLSA cites as a potential risk, it is still, much lower than what it was historically for Britannia. The third thing they say is that they expect volumes in, or they expect FY24 revenues to be volume-led. When does a company see volume-led growth? When there is not enough price-led growth? When does a company not take price hikes? When the raw material prices are not increasing.
When you don't have raw material inflation.
So then how is it that raw material inflation is a risk?
Okay.
So those are a bunch of things which I found confusing. The street is obviously going with the headline of the report. The details, I believe, are a little, conflicting. So let's see how the stock performs from a long-term standpoint. And mind you, the target price is 4,060.
Yeah.
1 year ago, the stock was close to around 3,000 odd rupees. It's rallied 30%. Currently, it's around 4,300 odd rupees. So downside would be around 4,060 according to them.
Okay, fair enough. So you're clearly, you have your own set of questions with respect to some of this hypothesis. Just very quickly, before we move to Nykaa, you mentioned raw material disinflation, if I could say that.
Yeah.
I mean, given what you're saying,
Yep.
that should actually aid margins. Anything else we should watch out for, X of this report on Britannia in the months to come?
I will most definitely watch out for a couple of things. One, they are on a high growth path as far as the new products are concerned. So this is the non-biscuit portfolio. Varun Berry on our channel has said that, from a 10-year standpoint, they expect 50% of their revenues to come from the non-biscuit portfolio. But in the next 3 years, they expect at least 15% of their revenues to come in from cakes, rusk, don't salivate yet, croissants. They have Winking Cow. They have a lot of cheese products that they've planned. So all these things will add to their portfolio, and all these things are gross margin accretive as well. So let's see whether this path plays out or not. For me, the bigger risk in Britannia is these adjacencies not playing out rather than any raw material inflation right now.
Okay.
So if these adjacencies don't play out, the extra premium that the street would have given the company for that growth coming
For becoming a beyond biscuits company.
May not come by. So that's a bigger risk than just...
We need to see how they, shape up with their other businesses, the non-biscuits part of the business. Got that. Okay, so now there is a new bear in town for a new age company, and that's Nykaa. We're talking about Macquarie. They have initiated coverage in the stock with an underperform rating. Now, their target is 115. Nykaa is currently around 150. So
at peak, it was 400.
I don't know, it's probably still painful memories for a lot of people on the street when you remind them of that. But okay, what is Macquarie saying? What are their issues with Nykaa now?
Okay, so Nykaa basically has 3 businesses. 2 of them comprise of the largest chunk of their companies. The 70% business comes in from their beauty business, and that is growing at a stable pace, 25-30 odd percent. The growth driver for the company will be the fashion business, which in the third quarter grew at around 50%.
Okay.
So
but low base. So therefore,
25% of their overall GMV comes in from fashion, but it's a high gross margin business.
Okay.
So you have stability in margins coming in from the beauty business, growth in revenues coming in from the fashion business. Macquarie has a problem with both of them. Why? Because they believe that the beauty business margins may be under some sort of risk, because going forward, the growth that will come in from smaller towns, will come in from them expanding in their beauty business on an offline basis, which obviously means that some sort of expenditure will be done on operations, etc. The third major thing is competition looms large. So a lot of large conglomerates, including Reliance, have announced their beauty foray. So once competition comes in, that puts a bit of a cap on the margins. So the margin driver or the stability provider of margins of the company under threat because of them going to smaller towns, expanding offline, and having competition. Coming to the fashion side of business, which is supposed to be the revenue driver, they have their experience of covering physical retail says that the company's own brand sort of foray that they've gotten into in fashion, and the plan of curating a lot of other brands on their platform at a time when people are actually going ahead and shopping online may put a risk to the growth prospects that we see in the fashion business. Okay. With all of this, the company will also, have to invest in building their other businesses, which is B2B, which is, all the other warehousing, etc., the back-end stuff that they're doing, and their own beauty brands too. So with that investment coming in, limited visibility on margins in the beauty business, limited visibility on growth in the fashion business, they believe that the future for them looks sketchy. The other thing is that the company is a new one. So the last few, we don't have data beyond the last couple of years that the company reported in the red herring prospectus in the last few quarters that they've reported their numbers. So limited operating history is something that limits their vision of predicting in the future as well. So they've been cautious. They said, okay, underperform at 115.
Okay, so that's Macquarie. Once again, I'm going to ask you a loaded question, expect you to answer in 60 seconds.
Yes.
What you said, right? The journey from 400 to 150.
Yeah.
If we just step back and take a look at what's happened, despite what you're saying that, the beauty business, steady margins, what has been off track? And, are there, the believers out there on the street who probably think, we're pretty close to the bottom here?
Well, there are a lot of believers on the street on Nykaa, and we've had a lot of market experts join us on our channel and say that they believe in these new age companies itself. The biggest trigger for them, closer to the bottom, is one, they have fair amount of cash on their books. Secondly, Nykaa is the only new business which is profit making from day one. Thirdly, while the interface of the business is new age where people go online and buy it, etc., the back end is absolutely pure old age, cutting edge, retail business where they buy products in there and store them in their warehouses, and then they sell it via the platform, which is the Nykaa website. So think of it as a Kirana store, with the Kirana store being the
digital
interface.
Yeah.
Everything else behind the sourcing, etc., is as good as a retail company. So that to that extent, Nykaa has a more solid business plan than everyone else. Of course, the risks of competition, the risks of low growth, the risks of them expanding beyond what their core area of comfort is always lies. But then again, the stock has corrected from 400 odd rupees.
Okay, all right. Thank you very much for all the perspective on both of those consumer companies. Well, there you have it. So you have movers and shakers on the way up and the way down today. Thank you very much for being with us in this edition of Who Moved the Market. We will see you again after you enjoy your great Holi break. Back again on Wednesday at 2 p.m.